Hello, I'm Tyler Smith, the Acting Inspector General at the Federal Deposit Insurance Corporation, the FDIC. I'm here to announce the issuance of our report on the FDIC's examinations of government-guaranteed loans. Federal agencies administer several government-guaranteed loan programs. These programs assist individuals and businesses seeking to buy homes, finance agricultural production, finance businesses, and purchase equipment. Such programs promote lending to rural and underserved communities and to borrowers with weak collateral or inadequate credit histories. Private lenders, such as banks that are regulated or insured by the FDIC, originate government-guaranteed loans on the federal agency's behalf. In fiscal year 2021, more than $1 trillion was dispersed in government-guaranteed loans by lenders on behalf of the U.S. Federal Housing Administration, the Department of Veterans Affairs, Small Business Administration, and Department of Agriculture. This figure grew by more than 154% since fiscal year 2019, from $433 billion. The lenders distributed nearly $3 trillion in government-guaranteed loans during this time. Without proper diligence and supervision, government-guaranteed loan programs can present substantial risk to the banks. If a bank engages in such programs without fully understanding or conforming to program requirements, its participation introduces risk to both the financial institution and to customers, including operational risk, compliance risk, reputational risk, and strategic risk. Banks may also be subject to increased fraud risk through government-guaranteed loan programs. In the Paycheck Protection Program, for example, there have been an estimated $64.2 billion in fraud. All of these risks, if left unmitigated, can impact the safety and soundness of a bank, leading to deterioration or failure. Ultimately, the FDIC's Deposit Insurance Fund could experience increased risk or losses. Our office conducted this evaluation to determine the effectiveness of the FDIC's examinations in identifying and addressing risks related to government-guaranteed loans for participating banks. I'm joined today by Luke Icknier, an audit manager from the OIG Office of Audits, Evaluations, and Cyber, who will discuss our evaluation findings and recommendations. Luke?
Thank you, Tyler. We determined that FDIC examinations were not always effective in identifying and addressing risks related to government-guaranteed loans. Specifically, we found that the FDIC's guidance did not adequately address risks present in government-guaranteed loan programs, and that the FDIC could improve its supervision of bank activities in these programs, including the Paycheck Protection Program. Further, we found that FDIC guidance differed from that of other federal bank regulators in key areas, and that the FDIC did not provide adequate training to its examination personnel on government-guaranteed loan programs. We also found that the FDIC did not maintain adequate data to identify and address risks in government-guaranteed loan programs, and did not effectively share information externally with other federal agencies or internally with examination staff to enhance its risk oversight. In addition, we determined that the FDIC's examination guidance did not provide clear instructions on the retention of examination work papers. We made 19 recommendations to improve the FDIC's supervision of banks that participate in government-guaranteed loan programs. We have recommended that the FDIC take the following actions: develop and implement guidance on the risks, treatment, and identification of government-guaranteed loans to promote consistency within the FDIC and with other federal bank regulators. Train FDIC personnel on the requirements and risks of government-guaranteed loan programs. Obtain improved data on government-guaranteed lending activities. Develop and implement guidance to facilitate information sharing with federal agencies and examination staff to enhance risk oversight. And to develop and implement updated guidance on the retention of supervisory business records. In responding, the FDIC agreed or partially agreed with all 19 recommendations and committed to taking corrective actions by March 31st, 2024. Back to you, Tyler.
Thank you, Luke. These findings and recommendations in this report will enhance the effectiveness of the FDIC's examinations in identifying and addressing risks related to government-guaranteed loans for participating banks. to find out more about this report and our other oversight work, including FDIC OIG investigations of fraud in government guaranteed loan programs, please visit our website at fdicoig.gov. You can also follow us at Twitter at FDIC_OIG. And remember, if you suspect fraud, waste, abuse, or mismanagement in FDIC programs and operations, or at FDIC regulated or insured banks, please contact our hotline at the same website and click on the red box in the upper right corner. Thank you again for joining us today.